Okay, for the third question, which is E6-13, consolidated balance sheet worksheet. So the December 31st 2008 balance sheet for Doors Corporation and its 70% owned subsidiary Hingle Company contain the following summarized amount. So we are given the balance sheet of December 31st 2008 for both company, and of course if it is given balance sheet, then it is already calculated all of the income and the net profit and etc. So basically this is just already the final number of the operation during the year. So Doors acquired the shares of Hingle Company on January 1st 2007. On December 31st 2008, assumed Doors sold inventory to Hingle during 2008 for $100,000, and Hingle sold inventory to Doors for $300,000. So Doors balance sheet contains inventory item purchased from Hingle for $95,000. The items cost Hingle $55,000 to produce. In addition, Hingle's inventory contains goods it purchased from Doors for $25,000 that Doors had produced for $15,000. Assume Hingle reported net income of $70,000 and dividends of $14,000. So A, we are required to prepare all of elimination entries. B, we are asked to prepare the consolidated balance sheet worksheet as of December 31st 2008. So as we can see here, there are two intercompany sale transactions. Okay, so the first one is Doors to Hingle, which is downstream sale, and then the second one is Hingle to Doors, which is an upstream sale. So if we have two sales, then we have to make two tables for the inventory intercompany transaction. Okay, so here it is. We go one by one. Okay, so Doors to Hingle, which is a downstream sale. Okay, for the total intercompany sale on the sales row, it is 100,000. Okay, and then because it is for Hingle, okay, so we need to see about Hingle's inventory. Okay, so Hingle's inventory contains goods it purchased from Doors for 25,000 that Doors had produced for 15,000. So both of this data, it is for the inventory on hand column. Okay, so that's why we put it here, 25,000 as the sales and then 15,000 as the COGS, because it is the cost that Doors had produced. Okay, so we can get the gross profit already of $10,000. Okay, if you want to calculate the gross profit percentage based on sales, it will be 40%. Okay, so if we have got the 40%, we can apply it to the previous two columns. So here it will be 40% times 100,000, it will become 40,000. So the COGS will be 60,000. And then here, okay, we can get it from 100,000 minus 25,000, so it is 75,000. Okay, and then the gross profit is 40% of 75,000, it will be 30,000, and then the COGS will be 45,000. So we have done for the downstream sale table. Then next we will go to the upstream sale table. Okay, so the same thing, we go back to the data. Hingle sold inventory to Doors for 300,000. That is the total intercompany sales row. Okay, and then because Hingle sold to Doors, so we need to see the Doors balance sheet. Okay, so have 95,000. Okay, which cost Hingle 55,000. So similar, this data is also we put it on the inventory on hand column. So 95,000 on the sales row and then 55,000 on the COGS row. Okay, so we can get a gross profit of 40,000 simply by 95,000 minus 55,000. Okay, so if you use gross profit percentage, okay, so 40,000 divided by 95,000 times 100%, it will approximately 42.11%. Okay, 42.11%. So if you apply it, maybe the number is not that good, but you just round it. Okay, round it to the nearest thousand. Okay, so if you apply to the total company sales gross profit, you will get approximately 126,000. So your COGS will be 174,000. And then if you for this number, you can simply get it from 300,000 minus 95,000, then you will get 205. Okay. And then for the gross profit, again 42.11% times 200 and 5,000, approximately it will be 86,000. So the COGS will be 119,000. So we have done the table and we can go to the elimination entry. So remember that because it is already 1 year, okay, then we have the basic elimination entries in the complete way. Okay, so we debit common stock, which is 150, and then we debit retained earnings. Why did we take 250? Okay, because usually when we take the retained earnings for the basic elimination entry, it is the beginning balance. Okay, we never take the ending balance. So we need to find the beginning balance from the Hingle company's retained earnings. Okay, because this data is already the ending balance. Yeah, so how to find it? Okay, we just simply take this 250, we reverse it back to the ending balance, to the beginning balance. So we need to minus the net income of Hingle and then plus the dividends of 14,000. So that's why we can get 194,000. Okay, and then for the income from Hingle, yeah, it is basically we will use 70% times the income of Hingle. Usually, okay, if there is no intercompany sale transaction. But remember, we have this intercompany sale transaction. Okay, for the income from Hingle, remember for downstream you need to allocate it all to the parent. So that's why this is 10,000 full for the parent. Okay, for the upstream sale, the deferred gross profit is 40,000. You need to allocate it to the parent and to the NCI. So it's all according to the percentage of ownership, right? So it is 70% of 40,000. So that's why it is 70% times 70,000, which is the income from Hingle, minus the 10% deferred gross profit from downstream sale, and then we minus 70% times 40,000 from the upstream sale. So you will get 11,000. And then the NCI and I of Hingle, okay, again you will take the percentage of income from Hingle, 30% times 70,000, minus the deferred gross profit from the upstream sale. Okay, so remember only upstream sale that will be allocated to the NCI. Okay, so that's why we minus here 30% times 40,000, you get 9,000. Okay, for the dividends declared, it is the same. Okay, usual like the way you do usually. Okay, 14,000, and then investment in Hingle, 242. Okay, why there is no calculation anymore? Because again, the numbers in the balance sheet is already at the ending balance. So usually for the basic elimination entry, we will take the ending balance, right? So that's why we don't need to do any calculation anymore. Just take 242. Okay, for NCI and NA, you just simply sum the debit minus the credit. You will get the number. Okay, and then for the intercompany sale elimination entry, okay, so remember, if there are two sales, then there are two elimination entries. So the first one is for the downstream, debit sales, credit COGS, credit inventory, just like the way you take usually. This for the sales, and then sum of 17,000 and 15,000 for COGS, then it's 10,000 for the inventory. And then for the upstream sale, similar. So you take 300,000 as the sales, and then 205 plus 55 as the COGS, and then 40,000 as the inventory. Okay, so that's for A, and then we go to B. We are asked to do the consolidated balance sheet worksheet. So only balance sheet part only. So you move the data. Okay, make sure it's balanced. And then you move all of the elimination entry into the debit credit column. Okay, I think for the inventory, investment, and then common stock and NCA and NA, it is normal. Okay, but for retained earnings, please pay attention because we didn't do the income statement and statement of retained earnings part. So all of these entries that is from the income statement and statement of retained earnings part will be directly moved to retained earnings. So you just follow the debit credit. For example, the retained earnings is debit, then you put it on debit. Okay, and then income from Hingle and then NCI and I also you put it on debit. Okay, and then dividends declared you put it on credit. And then the sales and COGS, because it is in the income statement, then we don't do the income statement part, so we just also move it to the retained earnings column. Okay, so the sales you just submit 100,000 plus 300,000, it will become 400,000. Similar with COGS also, you submit 90 plus 260 will become 350, and then the rest is the same when you move it to the consolidated column. Okay, so for retained earnings, this plus this, and then you minus all of the debit, you plus all of the credit, then you will get 530 again. Okay, so that's all for the third question.